from one big cap sector to another. Our next guest has been watching large cap health names and says that one stock in particular is still cheaper than you think, thanks to its very long-term thinking. Well, for more on this, David Moberley joins us now from Paradice Investment Management in Sydney. Well, welcome. You can't think of two businesses that are fundamentally more different than Facebook and CSL. However, I suppose the same questions are always getting asked about them. You know, is CSL just too exy, or is it just, again, this story that has so much growth potential ahead of it that it's worth paying up big now?
Morning, guys. Thanks for your time. CSL, as you mentioned, it's one of the stocks that's done quite well for us. It's been a core holding of our fund for a very long time. It's a pretty complicated business, but I think a lot of people do tend to overcomplicate it. And just to think of it simply, they've got two divisions. Firstly, one division collects plasma through donated blood, and it splits that into a number of different components to treat complex diseases, and another division which basically develops and sells flu vaccines. For us, it's one of the highest quality businesses in the market, and a lot of people tend to try and look at businesses quite simplistically and sort of dividing the earnings by the share price and trying to get a one-year multiple. And I think for us, that's highly simplistic and tends to undercapitalize some of the value that has been created under the hood. CSL, so it trades at about 40 times, which, as I was saying, might sound like a high number. The market's on around 20, so that's about a premium of about 2 times. It's actually not a huge premium when you look back at the stock through history. In actual fact, for that sort of quality business, it's probably about fair. But I think the point I was trying to make about being overly simplistic, CSL's actually been increasing its R&D budget quite substantially over the last few years, and it's currently expensing about $1 billion of R&D to fund a number of clinical trials through its P&L. So that investment is actually suppressing the bottom line of the earnings. And this business has delivered huge returns historically on their R&D, and their ROIC tends to run into the mid-20s. So it's not very sensible in our view to value a company on a one-year PE like this. And obviously there's a lot of value in the R&D pipeline that's not been reflected in this year's earnings.
So David, where do you see CSL share price going to? Obviously that's what a lot of investors are out there. What kind of capital returns are you looking at?
We all love to have a crystal ball. That's not really the way we think about it. We're more sort of trying to find value in the stock to deploy capital over a medium-term view. And one of the benefits of a company like CSL is there is a lot of latent value in the company, and that R&D pipeline I just spoke to has some huge potential. One of the drugs that they're developing is called CSL 112. It's designed around removing cholesterol from the arteries, which can lead to heart attacks or strokes, and they're partway through a phase 3 clinical trial. The product has a huge market opportunity with significant unmet demand, and on our estimates, that if the product's successful, could generate up to a third of the current IG business revenue at very high margin. And the sweetener in terms of value creation is really around these last liter economics of this fractionation process. And that is to say, I guess in simple terms, the product can be manufactured out of existing raw materials, some of which are wasted, which can drive the overall margin of the business significantly higher. So it's not really a one-trick pony that we're just trying to generate a quick buck out of. This is a core holding in the portfolio, which we think will drive returns over the medium term.
You really with CSL. David, I'm curious to get your thoughts now that we're at the tail end of reporting season. What other sort of major thematics or trends were you guys looking for at the outset that have perhaps come to fruition that now are, you know, helping to dictate where you'll be putting some of your capital?
Yeah, I think one of the more obvious trends over the reporting season was the strength of that retail sector in the market, or the consumer. And as we know, that when the country was put into lockdown, a huge amount of government stimulus packages were paid, including JobKeeper, JobSeeker, rental and mortgage payment deferrals. And we also saw a huge amount of withdrawals from super accounts. That basically meant there was a huge amount of money injected into the hands of the consumer. And once we saw cases start to decelerate and concerns around future employment, had started to dissipate, we saw the consumer come back with a vengeance, and there were very few categories where you could actually spend your money given the lockdown. So a few retailers actually saw huge benefits. So companies like JB Hi-Fi and Harvey Norman seeing 40% increases in like-for-likes sales was just enormous. But I think moving forward, it's something we're a little cautious in terms of capitalizing that level of earnings for many of these companies, which are trading at record high valuations, but also on record results. And as the economy eventually reopens, you would expect to see some of that spend allocated back to other categories. And I think some of these retailers may find those results difficult to cycle moving forward.
David, just to go and finish off, we've got 8 coronavirus vaccine trials that are currently underway in the phase 3 stage. There's a lot of excitement out there about a potential vaccine arriving. If there's a couple of stocks out there that you think could benefit more than others in this environment, what could you go and recommend?
Yeah, absolutely. We've been thinking about this as well over the last few months, and to the extent the market's become a little bit bifurcated between stocks that are beneficiaries and stocks that have got headwinds from COVID. Obviously, the reverse happens if we see a vaccine announcement. And while we think that there'll be quite a fair bit of time between a phase 3 positive trial announcement and an actual vaccine getting developed, I think the market will obviously look forward and price that pretty quickly. One of the stocks we've been in for a long time, and it's another core holding in the fund, is IDP Education. Now, these guys deliver high-stakes English language testing, and they've also got a student placement business helping international students from a range of countries travel overseas to study. So clearly, the business has been heavily impacted by lack of international mobility, and the fact that international students basically can't travel. But you're already seeing quite strong demand indicators. And any reopening of borders, which has already been trialled in a number of key markets with strict quarantine measures, would see a huge re-rating in the stock. So again, this is a business that delivers really strong returns, has great management, and we see multiple sources of value creation aside from its growth in its core markets. So we'd be a happy holder of that name, even if a recovery was longer to eventuate than expected. And I think that's really how you have to think about investing in the current environment, given the level of uncertainty.
David Moberley from Paradice Investment Management, thanks for your time this morning. Enjoy the rest of your day.
Thanks, guys.
Thank you.